all credit is created equal. This couldn't be further from the truth, ladies and gents. On the authorized user side, though, this is typically used within a family dynamic. And so this actually was used for me when I was building out my personal credit. My dad put me on one of his Bank of America cards, which at the time was like 20, maybe $21,000 on it. That helped fast track my credit profile, right? So it immediately shot up my credit score, which is what it's used for essentially right now. Now, you can use the authorized user approach in the building phase, but you don't just want to solely rely on it. This is why, again, all credit is not created equal. The way that it works is you'll use the authorized user or the authorized user approach, which is where you're kind of piggybacking off of maybe a parent's credit, a sibling, or a spouse or a partner. And you're going to use that so that you can, again, nicely, what I would say is this is like the easiest way to break it down is nicely give your credit a nice bump, nicely a nice cushion so that you can then go in and get access to your own primary trade lines. Now, if you have more than 3 authorized users on your credit profile and you only have, say, one primary account, that's known as a thin file. And so authorized user accounts carry far less weight for future funding, whether on the personal or on the business side, as you again go into the banks or as you go in to get things like vehicles or mortgages. Banks, financial institutions, and underwriters, they want to see your own primary accounts. So, a good rule of thumb is no more than 2, 3 at the absolute most. Once you get to that threshold, that's when you want to, if you haven't done so already, especially if you're in the rebuilding phase of your credit, that's when you want to go back in and start working your way into 3, 4, I'd say minimum 5 primary trade lines added to your profile. That can come in forms of 3 revolving accounts, which are 3 credit cards, and then 2 maybe installments, which is maybe a personal loan or a student loan that counts as well that you're paying off on time, and also maybe an auto loan or even a mortgage, right? So either one of those, just kind of keep that ratio in mind. And then we have 2 sources of credit. These are bank issued credit lines or credit cards, and then you have store issued credit lines or credit cards. Now, sometimes people confuse this because they say, wait a minute, I have access to, say, a Macy's card, and it said that, it's backed by American Express, or there's like a little American Express on there. And so I have an American Express card. That's a store issued card. And so what ends up happening is that you'll get that card and you think that you have a financial issued card or a bank issued card, and that banks see that as one and one the same. It's not. And so the only products that are going to, again, work in your favor for, again, in the future, if you plan on buying homes, if you plan on getting vehicles at a good rate, if you plan on working your way into business credit lines, is by having bank issued cards. This means that you're applying directly with the banks, directly with the credit unions. Not saying that a store card, if you needed it for maybe a grandiose deal that you saw, even though I don't really find it much of a need outside of that. Should you not get it, right? One of my first credit cards was a Best Buy card. I think I had at the time it was like, I think it was Synchrony. Synchrony Bank was underwriting them. It was either Synchrony or Capital One. This was a while ago. And I believe at the time it was like $500 off your next purchase if you spend more than like $2,000. I was going to spend more than $2,000. So at the time, that made sense because I was getting myself a laptop, right? Situations like that, but you still do very much so want to be careful because you don't want to get caught into a consumer cycle. But that would be the difference between a bank issued card, which again is directly with the bank's credit unions, and a store issued card. This is why all credit is not created equal. You have revolving credit lines, and then you have installment credit lines. I'm going to give you 2 real world scenarios. Revolving credit lines are things like personal lines of credit and credit cards, meaning if you have a $100 credit card and you pay off, let's say you have a $20 balance that's on it, and you pay off the $20, guess what? Next month, once that statement reports, that account essentially replenishes, and you now have access to, again, $100 That's known as a revolving line. But let's take a look at the other side though, which is the installment credit lines. How does that work? Think of this kind of like an auto loan, a student loan, a mortgage, a personal loan. Those are all installment loans, meaning once you pay off a car, that is it. That goes off into your credit history as a paid off loan. In order for you to go back out and get an installment credit line or an installment loan, you would have to go out and reapply for that. Now, there's pros and cons to each of them. We're not going to break that necessarily down in this video, but the pros of revolving accounts is exactly what that sounds like. You can continually use that and increase those accounts. The pros of installment loans, those are used more for big lump sum payments, cars, boats, jet skis. If you maybe a good one that I've seen is if you have maybe a home that you're looking to repair, you can take out a loan against that so that you can raise the value of your property or of your properties. If maybe, again, you were looking to do more of an investing type of approach. But with that in mind, there's two types of accounts. You have your primary accounts, and then you have authorized users. Now, whenever I say accounts, credit lines, or trade lines, that's essentially used interchangeably. Sometimes you hear primary accounts, primary trade lines, or primary credit lines. Sometimes you hear authorized users, authorized trade lines, just so you know it's all one and one the same, right? Don't get too confused with the lingo here. So with primary accounts, these are accounts that belong to you, meaning you went out, you applied, you got the hard inquiry, you got your credit ran, and you were approved for said amount. All credit is not created equal. There's two forms of credit.